Hello everyone and welcome to today's webinar. My name's Louisa Gaynor and I'm a Senior Client Advisor here at Netwealth. And as you can see today, we're joined by my colleague Fred, who's also a member of the Netwealth advisory team. And today in this session, we're going to be talking about maximising your GIA and ISA opportunities at tax year end. So we'll be thinking about the allowances that are available to you, the thought about gifting from your ISAs and your general investment accounts, the impact that falling interest rates have on investment returns, and the importance of utilising all these things on an ongoing basis. So I thought what would be helpful is just to set the scene a little bit. So this first slide that we're going to look at is really trying to highlight the importance of staying invested. When interest rates have been high, as they have been quite recently and still are to an extent, you do actually get rewarded for taking on no market risk. You're seeing some return on your pot. But actually, the key there is that that is not going to last too long. And is it going to keep pace with inflation through time? And I think that's what this chart here shows quite nicely. So what we're looking at here are two portfolios, both worth £100,000. You've got one portfolio that's just a cash portfolio, and you can see that in the dark blue line. And you've got another that's invested in line with our Netwealth risk level 4 portfolio. So that's our balanced portfolio with around about 50% in equities and 50% in fixed income. And what we've done here is we've taken the start of this investment point to before the financial crisis, 2007, because we wanted to incorporate the impact that that would have on your overall asset base. And you can see if we follow the dark blue cash line first, that actually you are getting rewarded for holding cash initially when interest rates were higher. But actually, as interest rates came down, you can see you're depleting the real value of your capital through time. And actually, if we look towards the right of the chart, even more so in the recent years when interest rates were actually starting to increase again. You can see that by the end of 2024, your pot that was worth £100,000 in 2007 is now worth in real terms just over £66,000. So you've actually lost money there. The impact of inflation has eroded the real value of your capital. And if we conversely look at that risk level 4 line, so the lighter blue, you can see that yes, when you first invested, going through 2007, 2008, you would have seen the portfolio dip quite significantly in value. And that's obviously never a nice place to be. But as you stood the test of time, you left the funds invested and you allowed them to recover with markets, what you would see is that you were sitting there then through the good and the bad, and you were able to harvest returns as and when they occurred. And actually, if we look across to the right of the chart now, you can see that by the end of 2024, the pot would have increased in real terms to just over £115,000. So you've made money there. And actually, you were better off from being invested than from sitting in cash, despite the market volatility that you would have seen over that period. So that's just a little bit of a starting point. And I now want to focus a bit more about what we're actually talking about today, which is looking at the tax allowances and tax efficiencies towards tax year end. So I'm going to pass over to Fred, who will hopefully just start us off by giving a bit of background as to where we are from a tax perspective this year.
Yes, thank you, Louisa. So we are going to go into more detail on the CGT allowances and the ISA allowances shortly, but I just want to focus on the other tax allowances that we all have. So income tax, as most of you will be aware, as working people, you have £12,570 personal tax-free allowance. The next slice of your income is taxed at 20%, up to £50,270. The slice above that is taxed at 40%, up to £125,140. And above that, it's 45%. But do be aware of various tax traps. So above 100,000 and between 100,000 and 125,140, you do start to have your personal allowance tapered down. So you have a tax trap, if you like, a marginal tax rate of 60%. So it is important to make sure that you're using your other tax allowances, and particularly pension allowances, to alleviate that. So anyway, if you go into dividend allowances, so you'll have £500 tax-free. And then above that, they are also taxed at basic, high and additional rates. That is lower than income tax. So some of you, particularly business owners, might pay yourself in dividends. And we also receive dividends in our investment portfolios. And then also pension allowances. So everybody gets £60,000 as long as they have sufficient earnings. But also you may be able to use carry forward. So if you haven't used your pension allowances in previous years, you can potentially do a larger contribution if you have relevant earnings or if you're a business owner. So do speak to your advisor about that, as it could be a good opportunity to make a larger pension contribution. Also, we are going to be talking about families in this presentation with ISAs. With pensions too, you can open a junior SIP for children, also potentially worth doing there. And then finally, pensions have traditionally been a very good way of saving inheritance tax because outside of your estate for that. From April 2027, they will be included. So there is some planning we can do around that to mitigate that.
It's interesting you say that as well, because I can see that, and as we've all seen, there's been a lot of noise around, as you say, the negativity of the changes with regards to pension rules and IHT. But as you've just implied there are still actually a lot of benefits to continuing to contribute, to utilising that allowance. And I think we will come on to that in a little bit more detail in a moment. But I just want to circle back to ISA allowances. So can you give a bit of a background as to kind of what that actually looks like in practice?
Yes, so everyone gets £20,000 ISA allowance there. Children also get £9,000. You also have a lifetime ISA for everybody from between the ages of 18 and 40 for £4,000. That's part of your £20,000 allowance, but the government will uplift that to £5,000. So 25% uplift on contributions, the maximum being £5,000 in total per year. One of the things about children's ISAs, so junior ISAs, is the £9,000 applicable up to 18, but from age 16, you can also open a cash ISA. So for 2 years, you can open a cash ISA for £20,000 alongside a junior ISA, so £29,000 for 2 years. So do make the most of that. Also, the huge benefit of ISAs is that they're tax sheltered. So the growth, the income is all tax free, and you don't have to do a tax return. So it's a very powerful tax wrapper to use. And we have seen a lot of people grow their wealth very quickly doing this. Not uncommon to see a few ISA millionaires, but they're very common also to see many of our clients with several £100,000 in them because they've used the allowance every year plus growth.
Yeah, that's great. And those 2 years where you can get that 29,000,
yeah.
If you're starting someone off that as their platform when they're 16, 17, you're doing a great job of putting them in a great position later on to be able to get on the property ladder or save for their retirement. And I think one of the other things to notice about LISAs is that while they are very attractive and you do get that 25% uplift from HMRC, there are certain restrictions as to when you can withdraw the money.
There is, yeah.
So it's certainly worth finding out a bit more about those. And they're around being a certain age, using it for purchasing your past property. The property must be under a certain value and you must get a mortgage with it. So certainly worth looking into and thinking quite carefully before deciding whether you want to use part of your ISA allowance on that.
Absolutely, yeah. It's really for buying a first home is the main reason, but some people also use it for retirement because it's, again, another sort of string to your retirement bow alongside a regular ISA, a lifetime ISA with that uplift can be quite useful.
Very nice.
If we now look at the capital gains tax allowances, these have also increased recently. So they were 10 and 20% until the recent budget. These have now gone up to 18 and 24%. The CGT allowance has also been frozen. So in previous years, you could have had 12,300 each. That was reduced to 6. Now it's 3 each. So for a couple, that's £6,000 of tax-free gains that they can utilise. Still worth doing though, but that has been frozen. You can offset losses made in previous years and also this year. One of the things we do at Netwealth, which not all advisors do, but it's very useful to do, is we can harvest the capital gains each year. So even if you're not withdrawing from that investment account, maybe you think, oh, I don't need the money for 10 years, you can still use that £3,000 allowance each year to basically increase the base cost and use some of those unrealized gains that when you do finally withdraw the money, the underlying gain is lower technically and you pay a lower tax rate. You can't carry forward the CGT allowance to future years. So if you don't use it in 1 year, then that will be lost on that. So I'm now going to go back to a case study, which Louisa is going to go through.
Yeah, definitely. Thank you, Fred. So, you've outlined the rules really nicely around general investment accounts and ISAs, but I thought there's been quite a lot of wording used here, so it'd be quite good to actually visualize this and see it in practice. So we've created this case study where we've said, okay, you've got an individual, he's an additional rate taxpayer, he's got £500,000 that he'd like to invest, and he's a family of 5. He's got a spouse and 3 children. He, in the first scenario, so in the chart on the left-hand side, is looking at investing in our risk level 7 portfolio. That's our highest risk portfolio. It's got just over 90% in global equities. And he's doing that through a general investment account, so a taxable portfolio. So any income that arises within the portfolio on an annual basis is subject to income tax at 45%, or the dividend rate, which we saw earlier. And any capital gains realized will also be subject to tax at 24%. So quite punitive there. But what you can see is that still over that 10-year period, so looking at that first chart between February 25 and February 35, that actually the portfolio does still grow in value. And at the end of that 10-year period has grown to just over £800,000. That's a great outcome. but how can we improve it? And that's what we can see in the right-hand side here. So you're looking at exactly the same scenario insofar as you have an individual, an additional rate taxpayer, a family of 5, 500K to invest. But rather than putting it all in his own name in a taxable portfolio, he's each year moving funds across to his ISA, his spouse's ISAs, and his children's junior ISAs. And the difference that makes in sheltering that tax and allowing that to compound through time is a difference of over £64,000. You can see there by the end of year 10, the money has grown to just over £860,000. And so if we just move to the next slide, I'm going to show you how that works in practice. So I appreciate there's a lot on the page here. In the top left-hand corner, we've got the general investment account, and we've got that money going out on an annual basis. And then the two charts on the top line show the two adult ISAs, so the spouses ISAs, and they're getting filled up with 20K each year for the next 10 years. And then dropping down to the line below, we've got the 3 child GIAs, which they can open from any point from being born to the age of 18. And you're contributing over that 10-year period, £9,000 to each of those. And that's how we achieve that £64,000 savings in average annual return scenarios. So you're forgetting about market risk, you're forgetting about inflation, you're forgetting even about fees, and you're looking at just being tax efficient and the difference that can make. It's well within our controls to do that. So it is really worth thinking about. And now I'm just going to pass back over to Fred, because I just want to really revisit how Netwealth can help clients do that from a planning perspective.
Yep. So using the ISA allowances is a really simple thing to do. So make sure that you use your £20,000 a year or as much as you can do. And also junior ISAs for children, if that's the case. Also for grandchildren, it can be useful for multiple generations. We have a tax allowances and services at Netwealth, so we can do this automatically for you from your GIA. The other thing in the CGT, using the CGT allowances in the GIA, we can automatically use the £3,000 allowance or target a specific amount of gain if you have gains elsewhere, or even target losses, which you can offset with gains elsewhere as well, and vice versa. If you've got a loss elsewhere, we can target a higher gain at Netwealth. We can also move money into your pensions from the GIA. So all of these things can happen very smoothly. With the pension contributions as well, we can also offer advice. We can offer advice for all of it, but there is a specific advice package for pension contributions because it is a more complicated area. We can work out how much allowances you have remaining, if there's carry forward, how much you can therefore contribute to your pension with us, or maybe a workplace pension, but you just need that help calculating what that could be. And then finally, although the IHT thresholds are frozen, so the 325 that everyone gets plus the 175,000 nil rate band, $500,000 each, $1 million for a couple, that has been frozen for a very long time now. So a lot more people are going to be included in that calculation in the future. So it might be worth thinking about some planning for the future. And the earlier you start, the better generally. So that might be gifting, it might be insurance. It could be a number of things, potentially also some trust planning. But do speak to your advisor about those things. And even if you're only doing a small thing, so moving a little bit to an ISA for each year, it can still make a huge difference.
Yeah, I think what we've learned from looking at these slides is that the earlier you start this plan, the better. These rules are always going to change with new governments and new legislation. So the key is getting on top of your financial position now and then managing it on an ongoing basis, because doing that will just make you much more agile in the future to adapt to those changing circumstances. And that's certainly something that we're here to help you with. So, Fred, I know you've worked in quite a lot of providing advice to clients. Can you give a bit more information about that?
Yeah, so we offer financial advice at Netwealth. There's a team of us, which we're both in. Combination of people starting out their career all the way to chartered financial planners with decades of experience. So do speak to us. There's no charge for an initial consultation. We're always happy to have just a chat, even if it's 5 minutes. If you have a few questions, let us know. But we can do advice on either a one-off or an ongoing basis. So some of our clients come to us to say, we have a question we want answering now. Maybe we want to do some retirement planning, just come up with a strategy for retirement, or maybe it's some IHT planning, and they want an ongoing relationship. So whichever one you want, we can provide a plan for that, and then we can provide the level of ongoing support that meets your needs. So ongoing is the most comprehensive service. That's charged at 0.35% per annum. And that includes all initial planning, financial plan that we'll review twice a year formally and make new advice as appropriate. Ongoing advice is charged on a fixed fee rate, on an hourly rate.
One-off advice, sorry.
One-off advice. And that will be, we'll give you a proposal and a fee quote for that to start out with. There's no ongoing support there, but we will help you implement that. And you can always come to us if you have any other questions. A lot of our clients are taking advice already, so do feel free to to give us an email or give us a call, and we can chat about how we can help.
Yeah, I think the idea is there is we're trying to be as flexible as possible to meet each client's needs and ensure they're getting the most value of our service. So those advice offerings that you just mentioned can be opted in or out of at any point. You can do it at the beginning of your relationship with us or much further down the line. And I think there's some real value there, because often clients in the accumulation phase of their life feel they just need guidance when they're looking at topping up their ISAs and family's wealth. But then it's when they get to the decumulation phase, they're entering retirement, that they want to be a bit more careful about how can I afford to retire and how do I know what I can afford to gift to my children in order to reduce the value of my estate for inheritance tax purposes.
Exactly. And just on that point about the accumulation phase, even on the accumulation phase, it could still be worth taking advice to make sure you're being as tax efficient as possible and getting money in the right places. But even on a small level, you could do a financial MOT, which we offer. So give you a good sense check of where you are and where you're likely to be in the next, let's say, 20 years before retirement. But certainly, give us a call. We'll speak about that. The final thing as well, just on the GIA and the ISAs, really simple. Log into your accounts and just check the tax allowances and services. That's all included in the service, and you can make sure that you are moving money into your ISAs if appropriate, moving money into junior ISAs if appropriate. But if you have any questions, let us know.
Perfect. Yeah. Well, thank you, Fred. And thank you very much for your time today.
Yep. Thank you, Louisa. Thank you, everyone.